Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Tamar Esner. She's a senior energy analyst for Nasdaq IR Intelligence, and we're here to focus on the energy sector, covering everything from OPEC, the price of oil, down to U.S. M&A within the energy space. So great to have you on set for sector talks. Excuse me, not trade talks.
Thank you, Jill.
All right, so oil, it's topping $60 for the first time in 4 months.
Yeah, largely underpinned by OPEC doing what they said that they were going to do, which is curtail supplies to the market. Saudi in particular is bearing the brunt of it, so they are driving the bus and they are reducing the shipments of oil to the U.S. They're at an all-time low from Saudi Arabia, and as a result of that, the market is really tight. We don't have enough barrels of oil, particularly of the heavier grades, which is the type of oil that OPEC produces, and that's propelled prices higher.
Well, the June OPEC meeting is pivotal. Why is that?
Because at that point, Saudi Arabia and the rest of OPEC plus Russia will decide if they are going to continue with the current plan, which is a curtailment of supply. So that agreement is only in place until June, and at the June meeting, they will decide if they are going to extend that plan for the end of the year or if they're going to terminate it. If they terminate it, we'll have more supplies to market. Prices will probably soften. If they continue, we'll probably continue to see prices move higher.
Well, there is low consensus on demand, and that is still an overhang on oil prices.
Yeah, so a lot of people think that oil prices would be higher right now than 60 if not for the concerns about demand. So we saw a real slowdown in demand growth last year, starting in the fourth quarter. And as the trade war with China remains an overhang, a lot of people are concerned that companies don't have enough confidence to continue investing, and that's resulted in less oil demand. So that remains a concern until we get greater clarity, I would say, on the trade war with China, as well as greater clarity on what the Federal Reserve is going to do in the U.S. in terms of maybe actually lowering interest rates or staying the course. Lower monetary policy would also help stimulate demand and also weaken the dollar, which would propel prices higher. So we're a little bit in wait-and-see mode on those two angles.
And that could be a double-edged sword too, because if prices get too high, you'll certainly hear it from the administration that they don't want higher oil prices or concerned about the impact on the consumer as it hits the pump. So I wonder if there's almost a ceiling in place for that as well.
Absolutely, because when prices get too high, you start to see demand destruction. So people will drive less. If prices are too high, companies will spend less, particularly in emerging markets where demand growth is really strong, but emerging markets have their own currency and they buy oil in dollars. So for them, when you have a higher oil price and they have a weaker currency, they really feel the impact much more so than we do in the U.S. It was interesting, there was actually a study done within the White House that found that higher oil prices is actually at this point beneficial for the U.S. economy, provided they don't get too high. That's because as we become more of a net exporter of oil, our home producers benefit from having a higher oil price, and that in turn impacts our economy and helps propel GDP.
Right, and those also create jobs that make
Absolutely.
really, I mean, those are nice salary jobs. Now, what about the U.S. shale growth debate?
So there is a debate. You've got the mid-sized companies and the small-sized companies. They are being pressured by their shareholders to cut back on their level of spending in shale in order to show more profitability. The problem is that as they cut back on spending, they're also going to be cutting back on their production growth. So there's that on the one side. On the other side, you see these large integrated companies like Exxon and Chevron, big name brands that are plowing more money than ever into shale because they are finding the higher returns there. The reason for that is they have these big, sprawling operations internationally that are very profitable, real cash flows that are able to subsidize their operations in shale. So we're not really sure yet how much shale will grow for the year. That was the big reason that oil prices took a nosedive, in our opinion, last year, was that shale growth really outpaced the level of demand growth and far exceeded anything that analysts were expecting at the end of 2017 when they were forecasting for 2018. So there is a big debate of just how much shale will grow in 2019 and how that will affect the global demand balance.
All right, and to wrap up here, do you think that could potentially be a catalyst for M&A within the energy space as the larger conglomerates scoop up some of these outliers?
It's a possibility. I think that a number of them have said that, we're good good to go with the acreage that we have and we want to develop them. M&A from the majors could become more of a story next year. I think to the extent that we do have M&A this year, it will more be merger of equals. So as these companies move into manufacturing mode, they find that they need more contiguous acreage. And the best way to do that is to land swap or to buy another company in order to have that scalability. Right now there's over 90 publicly traded E&Ps and 7,000 E&Ps. It's a lot. I think that these companies would have an easier time differentiating themselves if there was a little bit more consolidation.
All right, thank you as always for
Thanks,
the insight. And thank you for joining me for Sector Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.